Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about cash flows. We talked about it conceptually. We've talked about why it was important. We've talked about the different styles. We've talked about what FASB wants you to get out of it. And we've talked about the difference between the simple version you learned in the past and the actual version that's used by companies. Then we jumped into an example. And so far, we've finished almost the first 5 steps of our Avery Arrowheads example. Step 1, which we did together, was to calculate a net cash change, which we could use as a check figure. Then in step 2, we created a series of worksheets that we could use to gather cash flow information as we found it. Then we went through and accounted for or made notes of all of the cash effects of specific transactions that we as accountants knew during the year were going to affect cash flows. And we kept careful notes of them so that when we got to the point where we needed to make a statement of cash flows, we could jot down all of that information and gather the cash flow relatively quickly. Then we went through the income statement. This was step 4, and we stripped out all of the non-cash events. Not in the income statement itself. We left that be because we want the accrual information there, but we stripped it out of our cash flow from operations section so that we would just be showing cash flows. Then in step 5, we started going through the balance sheet. We were looking for working capital accounts that help us convert from our accrual information in our income statement to our cash flow information. And we were going through all of the balance sheet accounts that aren't working capital to make sure that we didn't miss anything. And in the process, we found 2 things that we had missed. And that's pretty common. As you're going through the year, you make note of all the special transactions, you do the best you can, but you're going to miss some things. And we did. We missed a payment to purchase a patent, and we missed a payment on some long-term debt. So we had missed a couple of things in our calculations and in our notes for step 3. We got all the way through long-term debt, going through the balance sheet. And then I invited you to go through the last section, the stockholders' equity section, and do the calculations by yourself to see if any adjustments needed to be made to our cash flow numbers. And we're going to just briefly go through that now. We're not going to keep jumping back and forth between our step 3 notes and step 4 notes. I'm just going to go through the T accounts briefly and show you what your T account should have looked like. And hopefully doing that, you'll easily be able to find any mistakes that you may have made. So let me jump back to PowerPoint where I can make some notes, and we will go through these together. So first off is our common stock. And I always do common stock and additional paid-in capital together because usually they're affected at the same time. So common stock started at 3 million. Additional paid-in capital started at 1.6 million. Give myself a little bit more room here. And let's see, common stock ended at 5,125,000. Additional paid-in capital ended at $3,525,000. Now, all of that information comes from our balance sheet. What we need to do next is go through step 3 and pull out everything about common stock and additional paid-in capital that we've already looked at from a cash flow perspective. And again, I'm not going to flip back and forth because you should have done this already, but you should have 3 changes: a conversion of bonds, which would have increased common stock by 375 and increased additional paid-in capital by 1,125,000. You had the issuance of some stock, and that increased common stock by 250 and additional paid-in capital by 800,000. And then there was a stock dividend, and that increased common stock by 1.5 million and did nothing to additional paid-in capital because it was a large stock dividend, and so we only recorded par value. And if you add those up for common stock, you get the 5,125,000. If you add up the additional paid-in capital, again, you get the 3,525,000, which means we've accounted for all of the transactions that affected these major accounts, and there's no additional cash flow. So that's the note I'm going to make on my balance sheet for both of these accounts. Next, we have our other paid-in capital. It went from 0 to 13,000. And we had one transaction that affected this. It was the sale of some treasury stock, and it increased other paid-in capital by $13,000, which means there's no additional cash here either. So let me make a note of that. The other holding gains and losses we did earlier, we did it as part of figuring out the effect of our marketable securities up in our current assets. Pensions, let's take a look at that. It started at 78 debit, ended at 62 debit. Additional other comprehensive income, pensions, started at a debit of 78, ended at a debit of 62, and if we went through our step 3 notes, we found a change of 16,000 already accounted for as part of converting pension expense to cash paid for pensions. And again, that makes it balance, so there's no additional cash here either. Hopefully you're starting to see a trend in the equity section. Because we do so many other adjustments and we've gone through so much already, it's very rare that by the time we get to equity, there's anything left. But occasionally you do find something like the sale of stock that you missed, putting it into your other notes, getting ready for step 3, or maybe the sale of some treasury stock, which is what we need to look at next. We started at 10,000. We ended at 38,000. We had a purchase of treasury stock for 38,000 and a sale that dropped treasury stock by 10,000. So once again, we'd made good notes and we have no additional cash effect to worry about for our treasury stock. The last one is retained earnings, and it takes a little bit more work to get retained earnings because not all of the numbers are laid out in step 3. Some of the numbers you have to gather from other places. So hopefully you were comfortable and were able to do this one. Let's take a look and see how you did. So our beginning retained earnings was $6,187,000. We ended with $4,735,000. Going through step 3, there was a stock dividend that reduced retained earnings by $1.5 million. And there were 2 other adjustments that we need to take into account. The first was a cash dividend. I'll show this one to you. It's in the dividends payable account. Right here, we had a debit to dividends payable and a credit to cash of $135. Right here, though, we had a credit to dividends payable of $203. The debit would have been the dividends account, which would have closed into retained earnings as part of our closing entries. So we actually have a debit of $203 to retained earnings here that's already been accounted for. But we can look in our retained earnings account, especially if there's no dividends payable account, and part of what's going on in retained earnings can show us what our dividends paid were for the year. So we can't use retained earnings to get to that dividends number if we don't have a note. So this is an important thing to know and to be able to catch. The last thing that happens to retained earnings happens every period, and hopefully you got it. We need to credit it by $251,000 because that's net income. If I add those up, we get to this $473. So there's no additional cash. And that wraps up. We've now gone through the 3 most important steps to doing the statement of cash flow. We've gone through the specific transactions we knew would affect cash, and we've made those adjustments. We've gone through the income statement and changed our cash flow for operations worksheet to get rid of the non-cash accruals. And we've gone through the working capital and other accounts to make sure that we do all of the other accrual adjustments to get my expense and revenue numbers into cash flow numbers, and also looked through all of the other accounts, non-working capital accounts, to make sure there was nothing that we missed. And now that we're done with all of that, we can start finishing the process, finishing up our worksheets, checking balances, and building our statement of cash flows. That's where we're headed in our next segment. We'll see you then.